Netflix stock is heavily undervalued, so in today's video I'm about to show you why it's my number one pick right now. We'll look at Netflix's business model, moat, and fundamentals. We'll also look at Netflix's investment risks and valuation towards the end. I currently own $600 worth of Netflix stock in my eToro portfolio. Once I'm done buying, I'll own $1,500 worth of Netflix stock, making up 15% of my $10,000 portfolio. So what is Netflix and how do they actually make money? Netflix is a video streaming service with over 300 million paid subscribers. It gives those subscribers access to TV shows, films, documentaries, and mobile games on demand. The company began as a DVD by mail service in 1997, but pivoted to streaming in 2007 and later began producing its own original content like House of Cards and Squid Game. The company now earns most of its money from paid subscriptions, but also has another fast-growing revenue stream from advertising. Prior to 2022, the company showed zero ads on its service. Since launching the ad-supported subscription tier, Netflix has become a major player in digital advertising. 55% of new signups choose the ad tier, and advertisers are willing to pay a premium rate for access to Netflix's global audience. This is transforming Netflix from a pure subscription business into a hybrid model. Once Netflix's advertising business scales, it should be highly profitable. This should push the company's profit margins higher over time. Now we know how Netflix makes money, but how do they defend their growing profits from huge competitors like Amazon, Disney, and YouTube? Netflix's most underrated competitive advantage is their ability to retain subscribers. It's okay if smaller competitors grow faster than Netflix. The most important question is, can they hold onto those subscribers long term? That's where the real value is. Netflix's customer churn, meaning the rate at which subscribers cancel their subscription, is industry leading, at around 2 to 3%. This is important because low churn increases the lifetime value of the customer. Netflix will benefit from more subscription revenue per user, more opportunities to upsell their premium tier, and more time to amortize their content costs over each user. That last point is important because it basically means Netflix can spend more money on its content than other streaming services, which improves their value proposition to the consumer. It's a virtuous cycle. More content spend equals more choice and higher value content for the customer, which lowers churn, meaning the company can then reinvest more into its content compared to competitors who can't match Netflix's retention rate. But does Netflix have pricing power? Pricing power is a company's ability to raise prices on its goods or services without negatively impacting their sales volume. Netflix raised prices again in 2025 with limited impact on retention, confirming that subscribers are willing to pay more because they perceive the value as high. Netflix's management explicitly noted that engagement and retention stayed strong despite higher prices in key markets. One of the reasons Netflix's churn stays low despite price increases is their reputation as the benchmark for industry pricing. When Netflix raises prices, every other streaming company follows suit. Most of these smaller streamers are much less profitable than Netflix, so they can't afford to compete on price anyway. That shows you that streaming isn't a commodity product. There is an underlying value proposition which differs depending on which streaming service you use. Netflix and YouTube are clearly in a league of their own. Then you've got Amazon, Disney, and even Spotify. Speaking of other streaming services, we also have to address the elephant in the room. Netflix recently announced a deal to acquire Warner Bros. Streaming and studio assets, including streaming rival HBO Max, for around $82.7 billion. This instantly gives Netflix control of some of the most valuable intellectual property in the world: Harry Potter, DC, Game of Thrones, The Sopranos, and dramatically strengthens every part of its competitive moat. Netflix also gets Warner Bros. Film Studio, which should help Netflix produce better original content, which is something they've been striving to do for a long time. HBO Max is one of the highest quality streaming services. HBO Max users already spend 2.8 hours per day on the platform, which is industry leading. This high engagement asset, coupled with Netflix's advertising ecosystem, will also increase Netflix's value in the eyes of advertisers, making their ad service more competitive over time. Netflix could offer a bundled subscription tier which includes both their own and HBO Max's streaming service. This would deepen the company's competitive moat, as bundling should lower churn and increase average revenue per user. Right, that's enough about Netflix's moat. Now we're going to get into the fundamentals. These are the numbers that back up Netflix's story. As you can see from the blue bar on this chart, Netflix spends very little on capex compared with its revenue of $43 billion in the last 12 months. This suggests the company has a lot of free cash flow left over after making all the necessary investments to maintain the company's operations. This is a good sign because it means Netflix can use its $9 billion of excess free cash flow to reinvest in new opportunities, buy back shares, pay dividends, or pay down debt. However, going back to the chart, the yellow, pink, and turquoise bars have a much larger impact on Netflix's bottom line. They spend $3.2 billion on sales and marketing, $1.8 billion on general and administrative, and $3.3 billion on research and development. These expenses may seem large, but they're not even the biggest impact on Netflix's profit. Netflix's largest expense is their content budget, which was $16.5 billion in the last 12 months. However, the trend is pretty positive because spending has fallen since 2022, whilst revenue has grown significantly. This positive trend, combined with Netflix's price increases, has seen operating margins explode from less than 3% in 2016 to nearly 30% in the last 12 months. I expect Netflix's margins to continue expanding over time with the growth of advertising revenue and further price increases. Despite the rosy picture I painted so far, there are investment risks with Netflix that I have to warn you about. The main risk is regarding Netflix's deal with Warner Bros., which we discussed earlier. The US Department of Justice could decide to block the deal to prevent Netflix from improving its competitive position. If that happens, not only will Netflix lose the chance to buy Warner Bros.' library of industry-leading IP, they'll have to pay Warner Bros. A breakup fee of $5.8 billion. Despite Netflix being a huge company with over $9 billion in cash to easily pay this fee, losing nearly $6 billion for basically nothing in return will have a bearish impact on the stock and make management look incompetent. I'm confident that Netflix's management team will be able to win round the DOJ. Netflix's management team say that they are not a dominant player in a narrow market because they are actually competing with YouTube, TikTok, gaming, and social media for their users' attention. This is undeniably true. Netflix subscribers could decide to watch YouTube free of charge, doom scroll on TikTok, or play video games rather than watch Netflix. So the reality is that Netflix doesn't only compete with other streaming services like Disney Plus and Amazon Prime. Now the part you've been waiting for. Let's look at Netflix's valuation. Netflix currently trades at a PE ratio of 23 times 2027's projected earnings. This is low compared with other big tech names like Alphabet at 26 times, Amazon at 25 times, and Spotify at 30 times. Over the past 6 months, Netflix's stock price has fallen almost 30% from a high of roughly $130 to around $90 per share today. Now let's go over to the DCF calculator on Qualtrim to see what kind of returns Netflix stock could offer from today's price. I'm going to use the free cash flow to value Netflix stock. The stock currently trades at a 2 to 3% free cash flow yield, but it's traded as high as 3.3% and as low as 1.3% in the last 2 years. I'm going to assume a 2.5% free cash flow yield for Netflix over the next 5 years. Now let's look at free cash flow per share growth. If you factor in continued user growth, increasing advertising revenue, and expanding profit margins, I think it's reasonable to assume Netflix grows at 18% annualized over the next 5 years. With a 2.5% free cash flow yield and 18% free cash flow per share growth, Netflix stock should return around 16.5% annualized over the next 5 years. These are market-beating returns. In this scenario, Netflix stock could reach $194 per share in 2031. If you enjoyed this video, click the next one for more.